Capital investment versus interest-free loans in a single-member LLC. Choosing the right financial structure. Starting and funding a single-member LLC, SMLLC, comes with important financial decisions, particularly when it comes to injecting money into the business. Many new business owners assume they can fund their LLC informally, either by making an investment, capital contribution, or lending money, as an interest-free loan. However, the way you structure this funding can have major legal, tax, and financial implications down the road. If not planned properly, these decisions can lead to IRS scrutiny, legal complications, or even loss of liability protection. In this article, we'll explore the key differences between capital investments and owner loans, the potential risks, and why capital investment is often the better choice for both financial and legal stability. Understanding capital investment versus owner loans. When an owner provides funding to their single-member LLC, there are two primary ways to structure the transaction. 1. Capital investment, capital contribution. 1. A capital investment, or capital contribution, is when the owner injects personal funds into the business without expecting repayment as if it were a loan. 2. The money becomes part of the owner's equity in the company. 3. The owner can later withdraw funds from the LLC through distributions or an owner's draw, depending on how the LLC is taxed. 2. Owner loan, debt financing to the LLC. 1. A loan is when the owner lends money to the LLC with the expectation that the business will repay it over time. 2. Typically, a loan would have an agreed-upon repayment schedule, and interest would be charged. 3. Even if interest is set at 0%, the IRS may still impute interest, meaning they could require the LLC to recognize and pay tax on interest that wasn't actually charged. While both options provide funding, choosing the wrong structure, or failing to properly document it, can cause unnecessary legal and tax problems. The risks of treating funding as an interest-free loan. At first glance, an interest-free loan may seem like an easy way to fund an LLC without permanently committing capital. However, this approach can lead to major issues including 1. IRS scrutiny and imputed interest issues. 1. The IRS expects arm's-length transactions, meaning that even if the business owner lends money to their LLC, the IRS may require a fair market interest rate to be applied. 2. If an interest-free loan is discovered, the IRS could impute interest, meaning they assume the LLC should have paid interest and tax the business accordingly. 3. The owner may also be required to report phantom interest income on their personal tax return, leading to unexpected tax burdens. 2. Loss of limited liability protection. 1. If the loan is not properly documented, with a promissory note, repayment terms, and actual payments, courts could view the loan as a personal contribution rather than legitimate debt. 2. This weakens the corporate veil, increasing the risk of personal liability for business debts. 3. Potential legal and accounting complications. 1. Loans must be recorded as a liability in the LLC's books, requiring formal repayment tracking. 2. If the LLC later faces financial trouble, unpaid owner loans could be challenged by creditors as disguised equity. 3. A poorly structured loan could be reclassified as income, leading to unexpected tax obligations. Why capital investment, equity, is often the better choice. For most single-member LLCs, capital investment is the cleaner, safer, and more tax-efficient way to fund the business. Here's why. 1. Simple and no repayment required. 1. Unlike loans, capital contributions do not require formal repayment schedules, avoiding unnecessary legal complexities. 2. Owners can still withdraw money later through distributions, without the hassle of structured loan payments. 2. No IRS interest complications. 1. Since a capital investment is not a loan, there are no issues with imputed interest, tax reporting, or IRS scrutiny. 2. This avoids the risk of additional taxable income being assigned to the owner. 3. Stronger liability protection. 1. Properly structured capital contributions reinforce the LLC's status as a separate legal entity, helping protect the owner's personal assets. 2. It eliminates the risk of courts reclassifying loans as equity in the event of a legal dispute. 4. More flexibility in taking money out. 1. Instead of making structured repayments like a loan, the owner can take distributions when the business is profitable. 2. Depending on the LLC's tax classification, these distributions may not be subject to self-employment taxes, if taxed as an S-corp. Best practices for structuring business funding. If you're considering injecting personal funds into your LLC, here's how to do it correctly. Choose capital investment for simplicity. Unless there is a strong reason for structuring it as a loan, capital contributions are usually the better option. If using a loan, follow legal formalities, draft a promissory note, charge fair market interest, and track repayments in the LLC's financial records. Keep business and personal finances separate. Transfer funds through your business bank account to reinforce the LLC's independence. Document the transaction properly. Whether it's a capital contribution or a loan, record the details in your LLC's operating agreement and financial statements. Consult a tax professional. A CPA or attorney can provide guidance on tax-efficient ways to structure business funding. Final thoughts. Plan your LLC's financial structure wisely. While both capital investment and owner loans can be used to fund a single-member LLC, the wrong approach can create unnecessary legal and tax complications. 1. Interest-free loans can lead to IRS scrutiny, loss of liability protection, and accounting headaches. 2. Capital contributions offer a simpler, cleaner, and safer way to inject money into an LLC without repayment obligations. By planning ahead and structuring your funding properly, you can avoid financial and legal pitfalls while ensuring your LLC remains in good standing. If you're unsure which option is best, consult a business attorney or tax professional to help determine the most advantageous approach for your situation. This is not financial or legal advice. This is merely some basic information to help you with developing your small business plans, to help you be better prepared for the seriousness of running your own business and working to make it a success.